Welcome to the Solo Investor. Most people think the stock market is about speed, fast trades, hot tips, perfect timing. But if that were true, the richest investors on earth would be the fastest traders. They're not. The truth is much quieter and far more powerful. The stock market doesn't reward constant action. It rewards ownership. Today I'm going to show you how people actually make money in the stock market. Without day trading, without gambling, and without staring at charts all day. Because once you understand this, investing stops feeling confusing and starts feeling predictable. When you buy a stock, you're not buying a ticker symbol. You're buying a piece of a real business, and businesses make money by growing. Here's how it works. If a company increases its profits over time, more people want to own it. That demand pushes the stock price higher. That's called a capital gain. But the idea is simple. Think about Apple. In the early 2000s, Apple was just a computer company. No iPhone, no App Store, no ecosystem. But the business kept growing. New products, higher profits, stronger brand. And over time, the stock followed the business. Not every year, not every month, but over decades. Here's the key lesson most beginners miss. Short-term prices move on emotion. Long-term prices move on business performance. That's why patient investors win. That's one way the market pays you. Here's the second. Some companies don't just grow, they pay you. These businesses generate steady profits and choose to share a portion of that cash with shareholders through dividends. That means if you own the stock, you get paid regularly, even if you never sell a single share. A classic example is Coca-Cola. For decades, Coca-Cola has paid investors cash every quarter. Markets go up, markets go down. The dividends keep coming. Many investors don't even spend that money. Instead, they reinvest it, automatically buying more shares. Those shares then generate even more dividends, creating a quiet compounding loop over time. This is how portfolios slowly transform from growth assets into income machines. Dividends don't feel exciting, they feel reliable. Every investor, whether they realize it or not, follows one of three paths. Path 1. Long-term investing. This is the foundation. Long-term investors buy strong companies or index funds and hold them for years. They don't try to time the market, they let time do the work. An example is someone who invested steadily into an S&P 500 index fund and lived through the dot-com crash, the 2008 financial crisis, and the COVID crash. They still came out ahead because markets recover. Path 2. Dividend investing. Dividend investors focus on income and stability. They build portfolios that can eventually help pay rent, groceries, and bills, eventually to become an income. This path is popular with people working toward financial independence, where investments start supporting life. Path 3. Trading. Trading is different. Professional traders manage risk carefully, accept losses, and treat trading like a job. Most beginners underestimate the discipline required. Trading can work, but it is not a shortcut, and it is not investing. Most beginners lose money because they confuse activity with progress. Trading is a profession, not a shortcut. When index funds were created, they evened the platform. Index funds made investing accessible to ordinary people. Instead of choosing individual companies, an investor buys one index fund and instantly owns technology companies, healthcare firms, manufacturers, retailers, and/or financial institutions. When the economy grows, the portfolio grows. This approach doesn't rely on being right about a single company. It relies on long-term economic progress. Over decades, that progress has rewarded patient investors more reliably than stock picking. Index funds don't remove risk. They remove unnecessary concentration. Here's the part no one wants to hear. Money alone doesn't build wealth. Time does. Two investors with two strategies. One starts investing $300 per month at age 25. The other starts investing $600 per month at age 40. Even though the second invests more each month, the first often ends with more because their money had more time to compound. Compounding rewards early starts, consistency, and patience. It quietly turns small decisions into large outcomes. Making money in the stock market isn't about beating the system. It's about aligning with it. As a solo investor, focus in the market should be on ownership over speculation, long-term systems over short-term excitement, and steady progress over perfect timing. You don't need to be extraordinary. You need to be consistent. The market doesn't reward the loudest voice, it rewards the longest commitment. Thanks for watching. Let us know in the comments what strategy works for you in the stock market. See you next week.